Picture this. You check the markets, and everything seems quiet. Too quiet. But underneath the surface, deep within the interbank ledgers of London and New York, a regulatory detonation has just occurred. This is not a drill. This is not a prediction. This is the exact moment the Bank for International Settlements enforces the Net Stable Funding Ratio, or NSFR, a rule that 99% of the financial world has ignored until right now. For the last 15 years, bullion banks have operated in a fantasy land where paper contracts were treated the same as physical metal. They could leverage their positions 32-1 without holding real reserves. But as of this morning, that game is over. The new rule demands that banks hold 85% stable funding for every single ounce of unallocated gold or silver on their books. Think about what that means. If a bank holds $1 billion in paper shorts, they now need $850 million in hard cash or Tier 1 capital to back it up. They do not have the cash, and they definitely do not have the physical metal. We are looking at a mathematical impossibility that is about to collide with a regulatory deadline. I need you to stop watching the distracting ticker tape for a moment. Listen to the data I am about to share, because the rules of the global banking system just flipped 180 degrees, and there is no going back. Before we dive into the ledger, I want to know who is in the room with us during this shift. Let me know in the comments below, where are you watching the markets from today? Are you in New York, London, or somewhere else? Put it in the comments. To understand the magnitude of this event, we have to strip away the noise of the daily news cycle and look directly at the plumbing of the financial system. We need to perform a forensic autopsy on the mechanics of the bullion banking sector as it existed before this morning and compare it to the cold, hard reality of the new regulatory framework. This is not about market sentiment. This is about structural engineering. And the structure has just been condemned. Let us begin with the definition of the asset itself. For decades, under the old Basel II framework, and even during the transitional phases of Basel III, unallocated gold and silver were treated as low-risk assets. When you buy unallocated metal from a bank, or when a bank sells a futures contract on the COMEX, they do not actually set aside specific bars of gold or silver with your serial number on them. Instead, they give you a claim, a promise, a liability on their balance sheet. This unallocated metal was considered as liquid as cash. It allowed the banks to operate with fractional reserves, issuing massive amounts of paper claims against a very small amount of physical inventory. But the Net Stable Funding Ratio, or NSFR, changes the classification of that asset entirely. As of right now, the Bank for International Settlements has reclassified unallocated precious metals. They are no longer considered stable, liquid assets like currency. They are now classified as high volatility, illiquid assets, requiring 85% stable funding. Let me break down exactly what that means for the balance sheet of a major bank, like JP Morgan or HSBC. Under the old rules, if a bank wanted to short the silver market to suppress the price, they could sell $1 billion worth of paper contracts. Because these contracts were considered low risk, the bank only had to hold a tiny fraction of that value in reserve capital, perhaps 0 to 5%. It was cheap. It was easy. It cost them almost nothing to manipulate the price downward by flooding the market with synthetic supply. However, under the strict enforcement of the NSFR starting today, that same $1 billion short position now carries a massive capital charge. The regulator is saying, if you want to hold a $1 billion unallocated position, you must have $850 million of Tier 1 capital sitting on your balance sheet to back it up. Tier 1 capital means cold, hard cash, or sovereign equity. It is the most expensive type of capital for a bank to hold. Suddenly, the cost of suppressing the price of silver has gone from near 0 to 85 cents on the dollar. The profit model for the bullion banks has just been inverted. It is no longer profitable to short the market. In fact, it is catastrophically expensive. Now, let us look at the scale of the trap they are in. We need to look at the open interest data from the COMEX. As of the close of business on Friday, February 6th, the total open interest in silver futures was 412,000 contracts. Each contract represents 5,000 ounces of silver. Do the math. That is 2,060 million ounces of paper silver currently existing as open claims. That is a staggering number, but it only becomes terrifying when you compare it to the physical reality. We have to look at the registered category in the COMEX vaults. Registered silver is the only metal that is actually available for immediate delivery to settle these contracts. As of Friday night, the total registered silver inventory was a mere 64 million ounces. Divide 2 billion, 60 million ounces of paper claims by 64 million ounces of physical metal. The result is a leverage ratio of 32-1. There are 32 claims for every single ounce of real silver. In a normal market, this leverage is sustained by confidence. Traders roll over their contracts, never asking for delivery. But the NSFR rule destroys that equilibrium because it penalizes the bank for holding the paper position. The banks cannot afford to keep these positions open. They have three choices, and all three are fatal to the current price structure. Option 1. They can extinguish the liability by buying back the short contracts. If they do this, they become massive buyers in a market with no sellers. They will be chasing the price higher, triggering a short squeeze that feeds on itself. Option 2. They can try to convert their unallocated positions into allocated positions. Under the new rules, allocated physical metal is still considered a Tier 1 asset with zero risk weighting. If the bank actually holds the physical bars, they do not need the 85% reserve. So, the incentive is to scramble for physical metal. But where are they going to find 2 billion ounces of silver? The total annual global mine production is only about 850 million ounces. The metal simply does not exist. Option 3. They can try to raise billions of dollars in new equity to meet the reserve requirement. But go to a shareholder meeting and try to tell your investors that you need to dilute their stock to back a losing short position in silver. It will not happen. This brings us to the most critical mechanism that is breaking down right before our eyes: the algorithmic suppression machine. For years, we have watched the price of silver get smashed down at exactly 10 a.m. or 2 p.m. with surgical precision. This was done through high-frequency trading algorithms using a technique called spoofing. The algorithm would place thousands of sell orders to create the illusion of massive supply, scaring other traders into selling, and then the algorithm would cancel its orders before they were executed. But here's the catch. The NSFR applies to the balance sheet. It applies to the risk exposure. If an algorithm opens a massive short position, even for a short period, the internal risk controls of the bank now have to account for that capital requirement. The compliance department cannot allow the trading desk to open positions that violate the 85% funding rule, even for a few minutes. The machine has been unplugged. The infinite supply of paper silver that has kept the price at $20 or $30 for a decade is gone. We are now entering a period of pure price discovery, where the only thing that matters is how much physical metal is actually in the vault. And the data tells us the vaults are empty. This is not a liquidity crisis in the traditional sense, where there is no cash. This is an asset crisis. The banking system is flush with fiat currency, but it is starving for collateral. They have printed trillions of dollars, euros, and yen, but they cannot print gold and silver. And now, the regulator has decided that only the unprintable assets count as real money. The banks are trapped in a room with only one exit, and the door is sized for a mouse, but they are the size of an elephant. As they try to squeeze through this regulatory deadline, the friction is going to set the paper market on fire. We are witnessing the mathematical end of the fractional reserve precious metals market. To fully grasp why today is different from every other market panic you have lived through, we must step back into the shadows of history. The financial markets have a short memory. Most traders operating today were not even born during the great crises of the 20th century. But the algorithms were written by people who studied them, and the central bankers who wrote the Basel III Accords were looking at exactly these historical precedents when they drafted the text that is now strangling the commercial banks. We are witnessing a recurrence of a specific historical pattern. It happens when a paper currency system reaches its mathematical limit. It happens when the claims on wealth exceed the actual wealth by a margin that can no longer be ignored. Go back to 1933. Franklin Delano Roosevelt signed Executive Order 6102. The history books tell you this was about stabilizing the banking system. They tell you it was to prevent hoarding. That is a polite fiction. The reality is that the United States banking system was insolvent. They had issued far more paper receipts for gold than there was gold in the vaults. When the public lost confidence and started demanding physical metal, the government had two choices. They could admit bankruptcy, or they could change the rules. They chose to change the rules. They criminalized the ownership of gold, confiscated it at $20.67 an ounce, and then immediately revalued it to $35 an ounce. It was a default disguised as a patriotic duty. Fast forward to 1971. The United States was bleeding gold reserves. The French government, under Charles de Gaulle, saw the data. They looked at the amount of printed dollars versus the amount of gold at Fort Knox and realized the United States was running a Ponzi scheme. France demanded their gold. They sent a battleship to New York to collect it. On August 15th, 1971, Richard Nixon closed the gold window. He told the world it was temporary. It was not temporary. It was a permanent default on the obligation to convert paper into physical assets. Now, look at today. The actors have changed, but the script is identical. The net stable funding ratio is the modern version of closing the gold window. The Bank for International Settlements is effectively saying that the paper market, the unallocated market, the fractional reserve market, is no longer valid. They are forcing a reconciliation between the paper price and the physical reality. But this time, it is not the government confiscating your gold. It is the regulators forcing the banks to stop selling paper gold they do not have. This distinction is critical. In 1980, when the Hunt brothers tried to corner the silver market, the regulators stepped in to save the banks. They changed the margin requirements. They limited the size of positions. They allowed the shorts to crush the Hunts. In 2011, when silver hit $49, the same thing happened. The CME Group raised margin requirements 5 times in 2 weeks to force liquidations. In those cases, the regulators were protecting the paper shorts. But today, the NSFR rule does the opposite. The regulator is attacking the paper shorts. The regulator is the one demanding the 85% capital reserve. The banks have lost their air cover. There is no one coming to save the short positions because the central banks themselves have moved to the other side of the trade. This brings us to the geopolitical axis that the mainstream media refuses to discuss. While Western commercial banks have been suppressing the price of gold and silver to keep the dollar looking strong, the Eastern central banks have been quietly draining the physical supply. This is the greatest arbitrage trade in human history, and it has been hiding in plain sight. For the last 6 years, since the NSFR was first proposed, the People's Bank of China and the Central Bank of Russia have been buying gold hand over fist. In 2024 alone, China imported over 7,000 metric tons of silver. That is roughly 25% of the entire global mine supply, vanishing into a single country. Where did it go? It did not go into jewelry. It did not go into iPhones. It went into strategic stockpiles. The Chinese government understands the industrial necessity of silver. They know that you cannot build a modern military, a solar grid, or a 5G network without it. They saw the Western banks suppressing the price, keeping it artificially low at $20 or $30, and they said thank you. They used our suppressed prices to buy our physical inventory. The West has been selling its family heirlooms to the East for pennies on the dollar. We have exported our real wealth in exchange for paper currency that is being inflated into oblivion. And now the trap snaps shut. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members like Saudi Arabia and the UAE, have been coordinating this move. They knew the Basel III deadline was coming. They knew the Western banks would be forced to scramble for physical metal to meet the ratios. By holding the physical inventory, the East now dictates the price. This is a transfer of power. For 50 years, the price of precious metals was determined in London and New York. It was determined by paper contracts. Starting today, the pricing power shifts to Shanghai and Mumbai. It shifts to the markets, where physical delivery is the standard, not the exception. We are watching the end of the petrodollar system and the birth of a commodity-backed reality. The Western banks are caught in the middle. They are short the very asset that their geopolitical rivals have cornered. This is not just a bank run. This is a strategic checkmate on a global scale. The NSFR is simply the mechanism that forces the West to admit it has no clothes. When the market fully digests this, we will see a divergence that will confuse the algorithms. The paper price on the COMEX might crash temporarily as positions are liquidated, but the physical price, the price you pay to actually get metal, will skyrocket. The spread between paper and physical will blow out to levels we have never seen. We are going back to 1971, but this time, there is no battleship coming to New York. The metal is already gone. Now, let us leave the abstract world of banking regulations and step into the hard reality of industrial supply chains. Because while the bankers play with paper, the world runs on metal. And silver is not just a monetary metal. It is the most conductive element on the periodic table. It is the single most critical component for the technologies that define the 21st century. You cannot build a solar panel without silver paste. You cannot build an electric vehicle without silver contacts in the battery management system. You cannot build a 5G tower, a smartphone, or a high-performance computer chip without silver. And most importantly, you cannot build a Tomahawk cruise missile or a guidance system for a fighter jet without it. This is where the paper manipulation collides with the laws of physics. For 15 years, the price of silver has been suppressed below its production cost. This has discouraged mining investment. We have seen mine supply stagnate while industrial demand has exploded. The solar industry alone now consumes nearly 20% of the annual silver supply. With the push for green energy mandates in Europe and the United States, that number is projected to double by 2030. But here is the problem. The industrial users, the companies like Tesla, Samsung, and Raytheon, do not care about the paper price on the COMEX. They need the physical metal to keep their factories running. If they cannot get silver, they cannot ship their products. So when the bullion banks scramble to cover their shorts under the new NSFR rules, they are competing directly with industrial giants who have deep pockets and zero price sensitivity. If the price of silver goes from $30 to $100 an ounce, it adds only a few dollars to the cost of an electric car or a solar panel, The manufacturers will pay it. They have to pay it. But for a bank holding a massive short position, that price move is a death sentence. We are seeing the early signs of this panic in the wholesale market right now. I have been tracking the inventory levels at the major refineries in Switzerland and the vaults in London. They are bleeding metal. The premiums for 1,000-ounce industrial bars, the kind used by factories, have started to decouple from the spot price. And this brings us to the street level. The retail bullion market is the canary in the coal mine. I want you to try something today. Pick up the phone and call your local coin shop or bullion dealer. Ask them if they have any American silver eagles in stock. Ask them what the premium is over the spot price. I called 3 major dealers yesterday. They all told me the same thing. We are sold out. One dealer told me they have a 6-week backlog for generic rounds. Another said they cannot get allocation from the U.S. Mint because the Mint is on allocation. The Mint cannot get enough silver blanks to meet the demand. When you look at the screen, you might see silver trading at $31, but try to buy an ounce of silver for $31. You cannot do it. The real price, the physical price, is $38, $40, or even $45 depending on the product. That gap, that premium, is the market screaming that the paper price is fake. This is what happens when a currency dies. The paper price becomes irrelevant. In Zimbabwe, during the hyperinflation, the stock market went up every day, but you could not buy a loaf of bread. In Weimar, Germany, the price of gold in marks went to trillions, but there was no gold to be found. We are seeing a bifurcation of the market. On one side, we have the paper market, the COMEX, where billions of ounces are traded by algorithms that never touch the metal. This market is about to break under the weight of the NSFR regulation. On the other side, we have the physical market, where real people and real industries are fighting for a finite resource. The dealers know what is coming. They are raising their buyback prices. They are paying overspot to get inventory from the public. This is backwardation in the retail market. It is a signal of extreme scarcity. And remember, silver is a tiny market. The entire annual supply of silver is worth less than $25 billion at current prices. That is a rounding error for a company like Apple or Microsoft. If even a small fraction of the investment capital that is currently sitting in overvalued tech stocks or government bonds decides to move into physical silver for safety, there is literally not enough metal to go around. The fire escape is the size of a pinhole, and everyone is rushing for it at the same time. The industrial users are grabbing the bars. The central banks are grabbing the bars, and the smart retail investors are grabbing the coins. The only ones left holding the empty bag will be the people who trusted the paper price on their screens. Do not let the spot price fool you. It is a ghost. The only truth is the weight of the metal in your hand. If you do not hold it, you do not own it. And starting today, owning it is going to become much, much harder. So, where does this leave us as the sun sets on this historic day? We are staring at 3 possible futures, and none of them look like the past. Scenario 1. The banks managed to secure emergency liquidity from the central banks to cover their immediate requirements. They print money to suppress the price for a few more days or weeks. This creates a hyperinflationary spike where silver shoots to $50, then $75, purely on monetary debasement. If this happens, holding cash is suicide. Scenario 2. The most likely outcome. A systemic force majeure. The COMEX and the London Bullion Market Association declare that due to unforeseen regulatory circumstances, they cannot deliver physical metal. They will settle your contracts in cash. You bet on silver, you won, but they pay you in depreciating dollars at a fixed rate, while the real street price of silver doubles or triples. The paper market disconnects permanently from the physical market. Scenario 3. The total reset. The NSFR is the first step toward a new monetary system backed by gold and silver, as the BRICS nations have planned. The dollar loses its reserve status, and physical precious metals become the only accepted collateral for global trade. In this world, an ounce of silver isn't worth $30. It is worth whatever the holder says it is worth.